The financial markets have always been a battlefield where emotions destroy more fortunes than bad analysis ever could. Long before computer screens flickered with real-time charts and before traders debated strategies on social media, the market tested men in silence and punished mistakes without mercy. In that unforgiving era, one trader stood apart, not because he was always right, but because he understood how to grow when he was right. That man was Jesse Livermore. Among his many lessons, one rule stands out as a masterclass in disciplined aggression, the one-quarter pyramiding rule. Livermore understood something most traders never fully grasp. Profits are not made by entering trades, they are made by building positions correctly. The one-quarter pyramiding rule was not about being clever or complex. It was about using simple math to align risk, psychology, and market behavior into one coherent strategy. This rule allowed Livermore to turn correct market opinions into massive fortunes while protecting himself from the one enemy he feared most, his own emotions. At its core, pyramiding is the act of adding to a winning position. Most traders either never add at all or add recklessly, turning profits into disasters. Livermore rejected both extremes. He believed adding to losers was financial suicide, but adding too aggressively to winners was equally dangerous. The one-quarter pyramiding rule was his answer, a methodical, mathematical approach to scaling into success. To understand this rule, one must first understand Livermore's mindset. He did not see trading as gambling. He saw it as a probability game where capital must be protected at all costs. His first rule was survival. Without survival, no strategy mattered. The one-quarter rule ensured that even when adding to a winning trade, risk remained controlled and losses, if they occurred, would never threaten the trader's existence. The logic behind the rule is simple yet profound. Livermore believed that the initial position should always be the largest. This goes directly against what most beginners do. Many traders start small, hesitate, and then add aggressively once they feel confident, usually near the top. Livermore did the opposite. He entered with conviction once the market confirmed his idea. Then, and only then, did he add smaller portions as the trade proved itself. In practical terms, the one-quarter pyramiding rule works like this. Suppose a trader has decided that his maximum position size for a particular trade is 1,000 shares. Under Livermore's rule, the trader would enter with 500 shares initially. This first entry carries the greatest risk because the market has not yet proven the trader correct. If the trade moves in the desired direction, confirming the trend, the trader then adds 250 shares. If the market continues to move favorably, he adds 125 shares, and finally 125 shares again, or a similar reduced amount. Each addition is smaller than the previous one. This structure accomplishes several critical objectives at once. First, the greatest exposure is taken when risk is lowest relative to the trader's confidence. Second, as the market moves further in the trader's favor, the probability of success increases, but the size of each new risk decreases. This creates a natural balance between aggression and caution. Livermore knew that markets trend, but they do not move in straight lines. Pullbacks are inevitable. By adding smaller increments, the trader avoids emotional overcommitment near market extremes. If a sudden reversal occurs after the final addition, the damage is limited because the last positions are the smallest. The trader keeps the bulk of his profits intact. Psychology played a massive role in Livermore's thinking. He often said that the market is never wrong, but opinions often are. The one-quarter pyramiding rule forced the trader to respect the market's feedback. Each addition was not based on hope or excitement, but on confirmation. If the market did not move as expected, the trader simply did not add. There was no debate, no ego involved. This rule also eliminated one of the most destructive habits in trading, the need to be constantly active. Under Livermore's method, patience was mandatory. Traders had to wait for the market to earn each additional unit of capital. In a world where most participants chase every tick, the one-quarter rule rewarded restraint. Another overlooked aspect of the one-quarter pyramiding rule is how it naturally improves trade management. Because positions are built gradually, the average entry price remains favorable. The trader is not chasing price, he is following strength. This approach aligns perfectly with Livermore's famous principle. The big money is not in the buying or selling, but in the waiting. Livermore also understood that trends have stages. Early in a trend, risk is higher, but reward potential is enormous. Later in a trend, reward diminishes while risk increases. The pyramiding structure mirrors this reality. Larger size is deployed earlier, smaller size later. This is not random, it is mathematical respect for demi. Niching returns. Many traders misunderstand pyramiding and turn it into leverage abuse. Livermore was clear. Pyramiding only works in strong, confirmed trends. It is not a tool for range-bound markets or choppy conditions. When the market lacks direction, adding to positions only compounds uncertainty. The one-quarter rule assumes the trader has already identified a genuine trend. Risk management is where this rule truly shines. Livermore never allowed a pyramided position to turn into a loss overall. Stops were adjusted as new positions were added. If the market reversed, the trader would often exit with a profit or, at worst, a small gain. This was not luck, it was structural design. Contrast this with the behavior of the average trader. Most traders add to losing positions, convincing themselves they are getting a better price. Livermore called this behavior averaging down, and he despised it. In his view, averaging down was a confession of being wrong, followed by stubborn refusal to accept reality. Pyramiding, by contrast, was a reward for being right. The elegance of the one-quarter rule lies in its adaptability. It can be applied to stocks, commodities, forex, and even modern markets like cryptocurrencies. Instrument does not matter. Human psychology does. Fear and greed behave the same way in every era. Livermore's rule exploits this consistency. Modern traders often ask whether such an old rule still works in algorithm-driven markets. The answer is yes, because trends still exist, and confirmation still matters. While execution speeds have changed, market structure remains driven by human behavior, institutional flows, and momentum. The one-quarter pyramiding rule aligns perfectly. With these forces, Livermore's own life offers powerful evidence of the rule's effectiveness. His greatest fortunes were built not on prediction, but on position management. He waited patiently, entered decisively, and then allowed the market to carry him forward. When he was wrong, he exited quickly. When he was right, he pressed his advantage, but always with control. It is important to note that Livermore never claimed this rule guaranteed success. No rule can eliminate losses. What it does eliminate is catastrophic failure. It transforms trading from an emotional struggle into a disciplined process. Losses become manageable, and winners become meaningful. For the modern trader, the lesson is clear. You do not need to trade more. You need to trade better. The one-quarter pyramiding rule teaches you to respect confirmation, control risk, and let winners grow without losing your mind. It demands patience, humility, and discipline, qualities that most traders lack, but every successful trader must develop. In the end, Jesse Livermore's brilliance was not in secret indicators or hidden formulas. It was in his understanding of himself and the market. The one-quarter pyramiding rule is a reflection of that understanding. It is math serving psychology, discipline serving opportunity. The market will always tempt traders to act impulsively, to add too fast, too late, or too emotionally. Livermore's rule stands as a timeless counterweight to that temptation. It reminds us that success in trading is not about excitement. It is about structure, patience, and the quiet confidence to let the market do the heavy lifting. And that is why, decades later, the one-quarter pyramiding rule remains one of the most powerful lessons ever written in the history of trading. The difference between a professional trader and an amateur is not found in indicators, chart patterns, or secret strategies. It lies in how they behave after they enter a trade. Jesse Livermore understood this truth long before trading psychology became a popular topic. He knew that entering a position was the easiest part of trading. Managing it was where fortunes were made or destroyed. This is why pyramiding, specifically his disciplined mathematical approach, became one of his most powerful weapons. To most traders, pyramiding sounds dangerous. Adding to a position feels counterintuitive, even reckless. The amateur mind associates adding with greed and excess, but Livermore saw it differently. He believed that not adding to a winning position was the real mistake. If the market was confirming his judgment, why should he limit his exposure to opportunity? The key was not whether to add, but how to add. The psychology behind pyramiding is deeply uncomfortable for most people. Human nature pushes traders to do the opposite of what works. When a trade is losing, the urge is to fix it by adding more. When a trade is winning, fear of losing profits causes hesitation. Livermore's pyramiding method attacked these instincts head-on. It forced traders to add only when they were right and to risk less as confidence increased. This psychological discipline is what separates professionals from amateurs. Professionals think in probabilities and processes. Amateurs think in outcomes and emotions. Livermore's pyramiding rule turned emotional reactions into structured decisions. Every add-on was planned in advance. There was no improvisation, no excitement, no panic, only execution. Livermore understood that markets reward conviction but punish stubbornness. Pyramiding works only when conviction is aligned with confirmation. The trader must have a clear thesis and wait for the market to validate it. Each additional position is not a guess, it is a response to evidence. This mindset transforms trading from prediction into participation. One of the most misunderstood aspects of pyramiding is risk exposure. Many assume that adding increases risk indefinitely. Livermore knew this was false when done correctly. In fact, pyramiding can reduce risk on a per-unit basis. As the trade moves in the trader's favor, stops are adjusted, and earlier positions are protected. The net risk often decreases even as position size increases. This concept is almost impossible for beginners to grasp, because they focus on position size instead of risk structure. Livermore focused on where he was wrong, not how much he owned. If the market invalidated his idea, he exited. If it confirmed it, he pressed the advantage carefully. This is professional thinking. Another psychological advantage of pyramiding is confidence reinforcement. Each successful add-on strengthens the trader's belief in the trade, not emotionally, but rationally. The market itself becomes the source of confidence. This removes the need for external validation, opinions, or news. Livermore famously ignored tips and forecasts. He trusted only price. The amateur trader, by contrast, seeks reassurance everywhere except from the market. Forums, social media, analysts, anything to reduce uncertainty. Pyramiding eliminates this need. The trader waits for the market to speak. If it stays silent, nothing is done. This silence is uncomfortable, but it is where discipline is built. Livermore also understood that pyramiding filters bad trades automatically. Weak trades rarely move far enough to justify multiple additions. They stall, reverse, or chop sideways. Strong trades, on the other hand, invite pyramiding naturally. This creates a portfolio where capital is concentrated in the best opportunities, not scattered across mediocre ideas. This concentration is what allowed Livermore to achieve extraordinary returns. He did not diversify for comfort, he focused for performance. Pyramiding was the mechanism that allowed this focus without reckless exposure. Each addition was earned, not assumed. Timing played a crucial role in Livermore's approach. He did not add at arbitrary price levels. He added at natural market confirmations, breakouts, consolidations, continuation patterns. These moments represented pauses in the trend, not exhaustion. By adding after these pauses, he aligned with momentum instead of chasing it. This patience is what amateurs lack. They see price moving and feel urgency. Livermore saw price moving and waited. He understood that trends unfold in waves. Missing the first wave was not a tragedy. Missing the structure was. Pyramiding allowed him to participate in multiple waves without emotional strain. Another reason pyramiding separates professionals from amateurs is accountability. When you pyramid, every decision is visible and deliberate. There is no hiding behind hope. Each add-on increases responsibility. This forces traders to be honest with themselves. Amateurs prefer vague plans. Professionals prefer clear rules. Livermore's journals reflected this clarity. He wrote not just about profits and losses, but about behavior. Why did he add? Why did he stop adding? Why did he exit? This level of self-awareness is rare but essential. Pyramiding magnifies both discipline and mistakes. Without rules, it becomes chaos. With rules, it becomes power. It is also important to understand when not to pyramid. Livermore avoided adding late in exhausted trends. He watched volume, price speed, and market sentiment. When moves became frantic, he slowed down. Pyramiding was a tool, not an obsession. Knowing when to stop is just as important as knowing when to add. Modern markets present new challenges, but the psychology remains unchanged. Algorithms may execute trades, but humans design them. Trends still form, fear and greed still dominate, and confirmation still matters. Pyramiding remains relevant because it is rooted in behavior, not technology. Many modern traders try to automate pyramiding without understanding its psychological foundation. They create rigid systems that add mechanically. Livermore's approach was structured but flexible. He responded to the market's character, not just its numbers. This discretion is difficult to code but essential to mastery. The ultimate lesson of pyramiding is trust. Trust in the process, trust in discipline, and trust in the market's message. Livermore trusted price more than opinion, and structure more than emotion. This trust allowed him to sit through volatility without panic, and to press his advantage without greed. For those willing to learn, pyramiding offers a mirror. It reveals impatience, fear, and overconfidence. It forces traders to confront their weaknesses. Most avoid it because it exposes too much. Professionals embrace it because it sharpens their edge. In the end, pyramiding is not a technique, it is a mindset. It demands maturity, patience, and humility. Jesse Livermore's legacy is not just his profits, but his understanding of human behavior under pressure. His pyramiding method stands as proof that success in trading is earned step by step, not chased all at once. And that is why pyramiding will always separate professionals from amateurs, because it requires becoming someone the market respects. Understanding a trading principle is easy. Applying it under pressure is where most traders fail. Jesse Livermore knew this better than anyone. He watched countless traders agree with sound ideas in theory, only to abandon them when real money was on the line. That is why his rules were never meant to stay on paper. They were designed to survive fear, greed, hesitation, and temptation. The one-quarter pyramiding rule was no exception. It was not a concept to admire. It was a discipline to execute. Livermore believed that the market rewards those who can act consistently in the face of uncertainty. Execution, not knowledge, separates winners from losers. Many traders understand pyramiding intellectually but collapse when it is time to add to a position. The fear of giving back profits, the anxiety of being wrong after being right, and the discomfort of increasing exposure all collide at once. Livermore anticipated this psychological storm and built a rule that could guide traders through it. To apply the one-quarter pyramiding rule in real markets, one must first accept a hard truth. Most trades will not qualify for pyramiding. This is not a weakness, it is a filter. Livermore did not pyramid often, but when he did, the results were transformative. The rule forces traders to wait for exceptional conditions, not average setups. The process begins long before the first order is placed. Livermore emphasized preparation. The trader must define the maximum total position size before entering the trade. This number is not negotiable. It is based on account size, risk tolerance, and market volatility. Without this predefined limit, pyramiding becomes improvisation. And improvisation leads to disaster. Once the maximum size is established, the trader plans the increments. The first entry is the largest, typically around half of the total intended position. This entry is made only after the market confirms the trader's idea through price action. Livermore never guessed tops or bottoms. He waited for the market to reveal direction. After entry, the trader does nothing. This waiting period is critical. The market must move favorably and convincingly. Small fluctuations are ignored. Only meaningful progress justifies the next step. This patience is where most traders fail. They confuse movement with confirmation. Livermore demanded clarity. When the market advances and confirms the trend, the trader adds the second portion, usually half the size of the first. This addition is not emotional, it is mechanical. The market has earned it. At this point, stops are adjusted to reduce overall risk. The trade begins to protect itself. As the trend continues, further additions are made in smaller and smaller increments. Each add-on is accompanied by tighter risk control. Eventually, the position reaches its full size, but the risk is often less than it was at the start. This is the paradox Livermore mastered: maximum exposure with minimum danger. Real markets, however, are not clean textbooks. Pullbacks occur. False breakouts happen. Livermore accounted for this by never adding during weakness. Additions were made during strength, after consolidations, breakouts, or renewed momentum. This distinction is crucial. Adding during pullbacks feels safer emotionally, but is riskier structurally. Livermore added when the market was proving him right, not when it was testing his patience. Execution also requires knowing when to stop adding. The final additions are the smallest for a reason. They represent diminishing opportunity and increasing risk. Livermore watched for signs of exhaustion, slowing momentum, abnormal volume, public excitement. When these appeared, he stopped pyramiding. Greed had no place in his process. Another critical aspect of execution is exit strategy. Livermore did not wait for perfect exits. He prioritized protection over perfection. When trends ended, he exited decisively. Because of pyramiding, most of his profits were built early. He did not need to squeeze the last dollar out of a move. This detachment gave him clarity when others hesitated. Applying the one-quarter pyramiding rule also requires accepting